Good afternoon. Welcome to the September edition of Austin Software Cooperatives. We are reviewing Slicing Pie by Mike Moyer. This is part three. We're going to be starting here on chapter six. Hopefully, we'll just blast through and get through the end here. We normally go through the book in this mind map format so people can follow along. And I've put in some some summaries of each portion in a logical format. So it's kind of new. We'll see how that works. So we're at the point here that we'll also do a little review of what the one of the main, or if the probably the main concept of the book is the grunt fund. We'll do a recap here in a bit, maybe 15, 20 minutes in, and we'll try to get through some of these edge case problems. Uh, we'll start here with subtracting a grunt. A grunt is basically an employee. And to review, the concept is making a fair allocation for a startup business for everyone that's employed or working or contributing. In order to do that fair allocation, the analogy is a pie and slicing the pie. And when you and then he also says the employees are grunts, but everybody who's contributing, the founders and all that, everyone's a grunt. So uh, now at some point in time, people are going to have to leave from the business, and that's going to trigger all manner of payouts and all kinds of things. Now we did go through a little bit of this previously, but we're just going to go through it real quickly here. Um, here. So when a grunt leaves the herd, either by choice or by force, great care must be taken in order to treat them fairly. Um, you want to treat them with dignity and respect, but some of the problems of how they leave because they have equity and how that's redistributed and all that stuff. That's kind of what this chapter is about. Some things to watch out for. The author reiterates this a bunch. The author's really passionate about getting people to contribute to early startups where there's no money involved yet. And he says that there's bad lessons and there's good lessons. Um, what's a good lesson is anything you can learn from and build on. He has this interesting concept of the bad lesson. It's something you learn, and then the when you learn, you actually degrade your future opportunities. So he considers when people join a startup and they get a bad allocation, for instance, that's a bad lesson because it will make them say, I never want to do that again. Instead of trying to figure out, oh, what's a more fair way to do startups, people tend to say that whole thing is scammy and I'm not a part of that. And he calls that a bad lesson. Someone being fired, forced out, it's kind of a bunch of examples within the book where they say here they could resign, they could be fired, they could be no longer able to work because they become disabled, or they could die. Any of those things could trigger a bad lesson. So you're trying to deal with that. So if a departing grunt is treated unfairly, then damage to the entire herd occurs. Of course, when people see someone being treated unfairly, then that's going to have repercussions, right? So damage to the entire herd occurs, then the leader ends up with a herd of disgruntled grunts. And so you got people thinking, hey, this place is not as fair as we thought it was. So what's going on here? So you have different examples or reasons why someone may lose interest in the cause. They might have a better offer and all these things like that. Now, the key concept here is is cause. Firing with cause, without cause, and with cause. So with cause is with a good cause applied. Right? So without cause, right? Resignation, sorry, not just firing, but termination, resignation, all this, someone leaving. Sometimes a grunt loses interest, right? Or sometimes they have external pressures, so they resign. In the case of resignation, without cause, the grunt has broken its commitment to the company and should not expect to retain the same slice of the pie as they would as an employee. This is part of the fairness here. So someone leaving, one of the problems with an early startup is absentee founders or absentee people with a large amount of equity. It makes later investors not want to invest. That's a big red flag for them. So when they see absentee people with 50% of the entity or even 20%, whatever, they could be like, hey, this is a problem here, you know, because people are incentivized to start an initiative. And if it looks somewhat decent, okay, well, I could sit on this equity, go on and do another thing. And if they get it going, while I'm doing, I got two things I'm working on now: my new venture and this other one. So you want to disincentivize that in some way, but in a fair way, not in an unfair way. So that would be resignation without cause, someone just leaving. And so they're not going to retain the same slice, but they're going to get a payout. So this has all this calculation. So if they resign without cause, then they forfeit all the pie. So that means equity, but they're going to be compensated. If they forfeit all the pie, then the company reallocates that grunt's other contributions without the multipliers. The multipliers we talked about previously in the previous portions, those are the things that make it to where what you're going to receive increases, as you get investment, as you get money, as you get customers, and all these other things, and what you're owed. And there's different multipliers based off of what they call ingredients for the pie. Like if you gave loans, if you did whatever you were contributing, time, if you took a cut instead of you actually are getting paid. So let's say if you were worth 100,000 a year and you said, well, based off of what I'm worth, but I'm only going to get paid 25,000. That 75,000 extra you didn't get paid, there's a multiplier on that. You don't just get, you know, in the future for, let's say you just did 1 year's worth, so you have 75,000 unpaid. You get more than that 75,000. You get a multiplier of that. It's like times two or maybe times four. I think it's times two, but all those numbers are in there. So you forfeit all that, and all your contributions and all that stuff, it gets recalculated, but you're going to get a payout at that time. And it may be that they're going to talk about it, I believe, but you're going to get, basically it's going to be a loan or a payout to you that may be over installments. And so at that point, you do all of that recalculation, right? So again, you still have your multiplier of your this. You had your 75,000, let's say, that was unpaid, and it was times two or times four, I forget. The company at that point can say, all right, we recalculated everything, and now we're going to buy back how much of the pie, total amount that's owed to you, right? We are going to buy that back from you right now. And this is the new theoretical value. And we're going to talk about theoretical value some more in the recap, but it's very important to call it theoretical value, right? But you can also resign and they don't do all that, and they without cause, and then the company says, "Oh, we're not going to buy it back. We're going to keep it," then they're going to secure a non-compete. So this is again the whole, hey, um, we have a good idea. Let's say, AI is all the hotness now. We're doing this AI thing. You're gonna leave and do the exact same AI niche that we're doing. We're doing AI for bakeries or something. And you said, oh, this other AI company does this bakeries. They have a good idea and I can contribute whatever I did over here. I'm gonna bring it right over there. Well, we know that most of the non-compete is not really an enforceable thing, but a lot of what is inside of the slicing by concept is it's about a morality and fairness and trust. So it's basically saying, hey, agree with us that you're not gonna go and just go straight to a competitor. Um, and sign that. It won't be enforceable at all. But the same way that a lot of this is essentially not enforceable as far as payouts and all the stuff and going to court and all that originally, from, let's say, the founders, and then there's new workers, and you have this grunt fund and how the payouts are going. A lot of it is trust. It's just very specific promises and commitments. So when something's violated, people are going back on what they're saying instead of it being vague. This is also a trust thing and saying, hey, well, oh, you won't sign that? Okay, well, there may be some other things that might be repercussions there as far as the payout and all that. But that's really saying this before and having this as a rule when people are going to resign. That's part of the idea. It's like, oh, if you leave without cause, you just feel like well, you have to go, right? Without cause, you just lose interest. This is part of what we do. And then someone at that point in time, even it's non enforceable, whatever, at that point in time, they should be like, I don't like that. And so you want to say that ahead of time. So what about with cause, with good cause? So sometimes a grunt is pushed out of a company or compelled to leave because the other grunts made decisions that change the situation so much that the grunt is not that it's not what they originally signed up for, right? So sometimes that's unavoidable, like a serious pivot and some other things like that. Sometimes somebody could die, all these other things like that, right? Um, so it says adverse change in compensation that does not affect the other participants on the same level. If the other grunts cut the grunts, this is a calculation that they do by 50%, but the other grunts GHRR stayed the same. Reallocation of the company more than 50 miles away. Like these are examples of why someone might leave. So, I think this is an adjustment of how the payouts are going to be. Someone can say, okay, I don't agree with that. Oh, we're all going to be on site and we're moving 50 miles away. Okay, I'm not okay with that. That would be resignation with a good cause. Change the strategy, all these things like that. But so let's see here, summary. If they resign with a good cause, then the grunt may maintain their pie minus any severance payments. Okay? If a grunt resigns with a good cause, then the company may buy back the pie at the higher of the unadjusted theoretical value or fair value with a 1 year protection clause. And if a grunt resigns with good cause, then the company is not entitled to a non compete. These are all the summary. So this non compete one is quite interesting. So if if you say you're no longer useful to us, for example, and we're doing AI bakeries, but we don't like how you know we're doing it a certain way and you're not able to contribute. And remember, any type of employee, you can have an administrative person, maybe they're not even um, really have a lot of like access to the intellectual property, or I won't even use that term, the the secrets, let's say. Um, that person should be allowed to. You're having to let them go essentially, and they should be allowed to seek work wherever. So there's that. Of course, you got the death. So if they and disability. So if they become disabled, that's the same as good cause. And if they die, the family should receive the full benefit. These are things that, of course, people would say are intuitive, but um, they don't really spell it out often. So if a grunt is terminated without cause, right? Again, oh, you're no longer useful, that type of thing. They're terminated without cause, then they're treated as the same as if they resigned with good cause. A little confusing there, but it's basically it's not their fault. Therefore, they're going to be treated at the higher level. All the things with the how you do the calculation or containing equity, all these things like that. If they're terminated with cause, then the so this is with cause instead of without cause. If they're terminated with cause, then the company should reallocate the pie without multipliers, retain the buyback right, and require a non-compete. Right. So this is they did something wrong within their examples of what is wrong. Termination with cause occurs, and the grunt must still be treated with respect and dignity. So you don't want to, again, the bad lesson concept. So a lot of this stuff is about buyback rights and equity and all that because there's no money. So there is this idea of are they retaining all these multipliers on the whole the work they did or not? And is it going to increase? And they should be able to get. Someone may say, I don't want to be bought out right now because I think you all are going to get bought in the future. And that's when equity is going to be finalized. Like you're going to get bought for $10 million. I want a percentage of that 10 million 5 years from now. I don't want to be bought out right now based off of my little multipliers of what I did. And I'm only going to get, 200,000. You lose that right to make that decision when it's without cause or if you resign without good cause and you get terminated with cause. Same thing. So you're still traded fairly, but you're not allowed to linger with on the upside, right? But you're still treated with all the bonuses. So really interesting and I think important concept to internalize and make explicit. Because what somebody may think is, oh, you're getting terminated with cause. So, oh, all of that free work you did, well, you just need to eat it. That's kind of what people would think. And this, so now keep that in mind. So let's say the person was saying obscene things to people or whatever, like they're just like, we just can't have you around. You're just a weirdo. So you're going to be terminated with cause for violating some HR stuff. This part, now with that in mind, you still need to do this. You still need to treat them with dignity and respect. That's kind of paradoxical, but you still should do that. And they still are going to, um, but they are going to, if they can pay out, like, oh, you have a multiplier of 4 times the 75,000 and we didn't pay you yet and all that. They have the right to buy that. They probably don't have any money. So it's still when they're able to pay it out, that's when they'll do it. And it's gonna increase, you know, by when it's time for them to get anyone, as soon as they get money that's triggered and they need to pay you. Right. But otherwise it's part of the equity. You're still in the equity. So all that is fair. Any questions about any of that stuff? All right, let's move on to this magic number. I'll tell you a high level of what this magic number is all about is when you leave this, what's called the grunt fund, theoretical value, and go into the traditional equity with shares and all of that stuff. And he says, oh, well, the magic number is $1 million. Basically it. Somebody says one of the main concepts in the book is your company is not worth nothing. It's worth absolutely nothing. It is worth nothing until you get money, until someone invests in you or you get customers or whatever. Is it all of the great ideas and all that stuff? It's nothing. So how you do that valuation is as soon as you get money. Now the different slices of pie, it's not shares, it's slices of pie, then they start having a value. And it's a theoretical value. That's what this TBV is. It's a theoretical value because it allows you basically to get around. It really is theoretical. So it's not, it's not like you're only doing that to get around. But it's theoretical because of tax reasons and other reasons. Um, if you actually are worth a certain amount of money, then there's implications of taxes. So you don't want to owe taxes on stuff and you need to get paid. So there's that, right? So one of the things that triggers a move, let's go ahead and read this. There are three situations where you would want to stop using the grunt fund: when you have built up so much theoretical value that you reach a point of diminishing returns, you started to build an actual business model with predictable returns, and the company receives a cash investment that is large enough to warrant legal and financial formalities. Right? So you start getting this theoretical value. Again, one of the main concepts of the book is when you start this a business, you have an idea. The idea is worth nothing. No one wants to give you money for an idea. When you turn it into a process that you can demonstrate outcomes, uh, predictable outcomes, at that point, that's what he's calling what a business is. And at that point, that's when someone will give you money. And so the idea is to get to that point so people can invest even before you have customers. So demonstrating that and all of that, there's a certain point where this theoretical value, everyone sees that it's great and everything. They want to join in, they want to contribute. You're having more and more people contributing, but they're not getting paid, or getting paid very little and all that. But you can reach a point to where there's so much theoretical value that new people will not, it will be a diminishing return on what they're expected as far as the equity. So like that's that. So theoretical base value grows so high that a small new contribution earns only a tiny slice, then the point of diminishing returns has been reached. If the point of diminishing returns has been reached, then you should convert the pie to real equity and adopt a new incentive program. This real equity means shares. It doesn't mean um, actual cash. So this is basically saying get legal and do the different entities, which we'll talk about in a second. If you convert the pie to real equity, then you stop using the grunt fund, right? So an actual business, not all businesses, not all companies need to take outside money. You may be smart or lucky enough to figure out how to grow your business based on revenues. This is, you know, very true. Some businesses don't need to be, I th- I would say that most of them don't need to take outside investment. but we just like to do that now. If a company develops a predictable revenue model with a clear cost structure and growth plan, then it's time to stop using the grunt fund and formalize equity with legal agreements. Right, so this is quite interesting. Let's read the rest of this. In cases, the right time to stop using the grunt fund is when you have developed a predictable business model that looks like it's going to be a winner. Looks like it's going to be. It's not yet. Predictable means that you have a revenue stream in the foreseeable future. This is customers. You understand your basic cost structure and you have a plan for growth. When you have this, you have an actual business that may have built actual value, and you will need to hammer out the equity details more formally, calling the attorney and all that, and going through all that. So it's kind of paradoxical because people will say, well, what's actual value if you don't have a customer yet? And they're saying, well, if it's really, really structured and you have promises and all this other stuff, and it's like, okay, you probably need to go off of what we're doing. Uh, if equity is being formalized, every grunt who has earned pie must be treated the same. Right? There shouldn't be any special things. Now, this is the magic number. So, if a company receives a cash investment of at least $1 million, then it must call the lawyers and accountants to document and formalize equity. If a formal investor imposes new terms, then all grunts must be treated the same under those new terms. Right. So the magic number is $1 million or more, is what he's saying. I think with inflation, it's probably going to increase or whatever. But now here's some caveats. If the number, like, let's say you want to pick a number yourself, like a billion sounds too hokey. He's saying if the number's too low, then their motivation will dip. If the number's too high, then the investors will look elsewhere for a better deal. Right. So let's go through that. If your magic number's too low and the other grunts won't walk away from the transaction with very much equity, right? That's the thing. Right. Then your motivation will dip. So they're looking at, we did all this work and someone's offering, we thought it was worth $5 million and someone's offering $500,000. That seems ridiculous. And, we shouldn't be selling shares of the company for that low. So it's going to dip their motivation. So that's why, you know, if you're going to make your own number, think about that. If the magic number is too high, then the investors will look elsewhere for a better deal, of course. Like what do you guys have? Oh, AI bakery. Oh, well, how much to, you know, invest in it? 50 million. We're taking over. There's like goodbye. Right. So that's what you're thinking of there. So if a cash investment is less than $1 million, then a personally guaranteed convertible loan may be an easier option. Right. So this is set up where it doesn't describe it, but you take you have the option to get paid by the investor has the option to get paid. So it's like the investor gives a loan to the business and they have an interest rate, and then they have the option when the next investors come in, they have the option to convert it to equity or get paid, and they get paid plus the interest. So they're like, here's a million, here's a this is well, they're saying less than $1 million. Like this, but so let's say it's 500,000, and it's like here's 500,000, and you need to pay me back, right? And okay, we're going to pay you back. Now you could do interest and payback at the end of some term, or it could be installments, but you're not making money. So it's probably at the end of the term. Right. And so at the end, let's say, well, we're going to look for more investors. We're going to use that 500,000 over the next 2 years, pay people, whatever. And we need to look for more investment. Oh, okay. Well, at the end of the 2 years, you're looking for the new investment. I'm going to look at those terms as an investor and say, well, I want because I was an early investor. I want this much equity, but you guys are going to fight me or whatever. That's fine. But I want to get paid my 500,000 plus interest at the end of that 2 years if I don't like that equity. And that's what I'm owed at that point, period. Um, that's convertible loan concept. If the negotiated valuation is high enough to motivate grunts and low enough to motivate the investors, then the deal will satisfy both sides. If the magic number is higher than the theoretical value of the grunts' contributions, then all participants should be higher, happy. So that's that. All things that people, when, of course, when you have the lawyers and you're doing all this other stuff, there's multiple rounds of the investment. Uh, that they're doing some of this, but then when you're doing like this early, you don't have lawyers and it's like three of you and all that. These are concepts that you should be have that you should have reasoned about when you're saying, okay, you own this much, you own this much. And again, going back to the concept of the book, if you just say, okay, you get 30%, you get 30%, you get 30%, that's called a static equity, right? He's calling it a pie, but static equity. And the first part of the book is arguing about all the problems that come with static equity. And so dynamic is the way to go. But when you do dynamic, it's theoretical, and you need to be explicit about what all changes. So any questions on the magic number? All right. Let's go through this recap quickly. This is I'm going to go through all the summary. So if you slice a pie before or after it is baked, then the method fails to account for ever changing needs of the fledgling business. That's what I just talked about as far as the dynamic versus static. That's he's calling that the slicing of the pie. So you slice everything and dynamically into quarters or thirds, and then you're not going to account for the ever changing needs. So one person could leave, one person could start doing extra work, double time, all this. That's all, but no one's getting payout, and so all of that in order to incentivize the right behaviors, you don't want to do that slicing. If an equity allocation method fails to account for the needs, then uncomfortable renegotiations follow and the company changes. So that's would be like, oh, we're starting a video game program, video game company, and you've got the front end, the back end, and the marketing person. The back end person comes in, does the absolute minimum, works like 3 months, leaves. Front end person comes through, works for years, and then um, the marketing person starts to work at the end of when the front end person is done. You've got, but let's say you split it three ways. Well, you may say in the beginning, you don't know how much work the back end needs, the front end needs, and the marketing needs. So now you've got a problem. You've got somebody basically trying to hedge their bets. You allow for the behavior of trying to do the smallest amount of work possible and leaving, going to do something else, and but yet having a third of this idea. And so that's what that would then you would trigger this uncomfortable renegotiation of, hey, we're not going to put the game out unless you take less than a third. That person can say, no, I think you're going to put the game out. I'm going to keep a third, and I just don't really care because I only did 3 months of work. So whatever, like that, negotiation, lawyers, all that. It's what you're going to run into when you do a static slicing. If uncomfortable renegotiations follow, then the entrepreneur should implement a grunt fund and dynamic equity split. So if you're going to do the grunt fund, you're going to have to track the theoretical value of every ingredient. And so there's something like 20 or 15 ingredients on what you're going to contribute. They'll all have multipliers, all that stuff. If the theoretical value is tracked, then each grunt receives pi in proportion to that value. They receive pi in proportion to that value. then the equity allocation of the startup is fair and equitable, and that's what you want in order to learn good lessons and not bad lessons. If an equity allocation is fair and equitable, then entrepreneurs avoid burning, hardworking grunts. This burning is the bad lessons. If early grunts calibrate the theoretical base too high and overestimate the company's eventual value, then the grunts become unhappy. So the earlies, like the founders and those things like that, you can have calibration where they're, let's say that, so there's a concept of calibrating. If you calibrate to where the early founders don't get compensated for the massive risks they were taking, then they're not going to be happy. If you calibrate it too much, basically they didn't take any risks, but they're owning all this percentage based off of some things that they were doing, right? So, um, let's say every early hour was worth 10 hours, or something like that, and that 10 hours was translated into equity. And then new people come on and they're saying, "Hey, I'm getting like 1% or 2%, even though I'm doing 80-hour work weeks and you guys are not." Right? And then they're just, that's not gonna work, right? So they're gonna be unhappy. So that calibration thing, it's the concepts there, but you're gonna have repercussions if you don't do it right. But if you partition off a fixed percentage of the pie, then the partition remains fixed while the rest adjusts to the new inputs. Again, the grunt fund is about treating people fairly, and you got to be motivated by money, but you're also motivated by being part of the game and all stuff. And then, of course, we talked about being resigning without cause and with cause. We just went over that, right? So there's that. That's a recap. Um, I'll upload the part one and part two soon. I think I may have already uploaded part one. This concept here, we've got like another 20 minutes. Let's try to get through this retrofitting a grunt fund. So in the very beginning, you've already launched the business. Chances are good you've already implemented a fixed split that is causing some angst amongst the founders. You now need to unwind your fixed split so that you can get on the right track with your equity. This will require you to retrofit a grunt fund. It's easy as long as everyone's willing. Well, what makes people willing? So, summary: the fixed split is causing angst amongst founders. Then the founders need to retrofit a grunt fund. So they say if there's no angst, you don't. Well, you're fine. So don't do it. Right. Um, if you have to retrofit a grunt fund, then you must secure buy-in for a dynamic equity split. The whole concept of dynamic versus static. So he has this concept of skinny versus fat grunts. What's a skinny grunt? Um, let's go into it. Skinny grunts will be easy to convince. They already feel cheated by the fat grunts, and as much as they like the business, they believe in the vision. Their motivation is probably waning. The fat grunts may be harder to convince because after retrofit, they will probably have a smaller portion of equity, and they will have to start working to maintain or grow their position in the company, right? But that's completely fair, right? So if team members are skinny grunts and read the book, like this slicing pie book, they're easy to convince. The problem is the fat grunts. Team members are fat grunts, then they're harder to convince, right? So he has a little email you can send them, that kind of thing. Um, let's go through this. You, a greedy fat grunt is someone who's comfortable with benefiting at the expense of others. And he just basically calls them an a-hole. It's best not to do business with a-holes, that kind of thing. But this is the really the behavior and the mentality, characteristic, I should say, of the fat grunt. They're comfortable at benefiting at the expense of others. Right? If a fat grunt refuses to cooperate, then that refusal signals a trust or greed issue. If a team member has a trust or greed issue, then the team should fire that member. And if an uncooperative fat grunt is irreplaceable, then a good grunt may need to leave and seek greener pastures. So if they can't leave, then other ones may leave. So you're still not out. You know, you may have to keep them, but oh well. you know, you're gonna the good people are gonna go. Yeah. If everyone's on board with the retrofit, then the team must allocate what pie would have been under the grunt fund from day one. That's going to be somewhat difficult because you may not have hours, right? So if accurate historical hours are unavailable, then you're going to have to classify contributors by time commitment level and estimate hours accordingly. Mm. So this is this retrofitting and trying to see what the slicing of the pie is going to be. He has some numbers here on how he's doing everything. After you retrofit, people simply continue earning pie, and if they outgrow the grunt fund, then you're going to issue stock. We talked about earlier. If a grunt's larger share results from transparent partitioning or calibration agreed by all, then it's fair, right? So bringing people into these rules, the grunt fund rules, again, they are all based on the agreements that we talked about earlier in the previous chapters. Then that the being transparent about those rules is part of the fairness instead of making something so complicated they can't understand. Any questions on this retrofitting? Let's go into this. Going out of business. There are two main reasons why an early stage startup fails. The first is the company goes bankrupt because it can't meet its financial obligations. The second is that the founders learn enough about the market to decide that it's not really as cool as they initially thought. Right? So part of doing a startup is learning about a space. And then once you learn about it and it's not good, you need to close up shop. Um, here's a chain that could make the basically force you to liquidate and go bankrupt. Fledgling company racks up debt that it can't service, right? Can't pay back or can't pay the installments on, and it must find a way to make the payments. So you oftentimes you you're doing your startup, you're able to secure a loan, or you did maybe that convertible loan from the investor, whatever. You're owed. I mean, you owe people money, right? And you have to pay it, service it. The company may have to find a way to make the payments, and the debt was personally guaranteed. So that could be the founders or whatever. Again, people who personally guarantee, they get a multiple as far as how much equity they get and all that in a company. Um, the guarantor grunt must cover the payments counted as a cash contribution times four, right? So let's say that you borrowed 100,000, and then now the company that there's it's personally guaranteed by one of the founders. Well, that founder, whenever if the company is goes out of business, right? That founder is owed whatever's liquidated by the business, they're owed times four. It's not just, oh, I guaranteed $100,000 loan and we use that money. And now we're getting liquidated and we have a bunch of, you know, let's say we have a bunch of vehicles and all this other stuff. We have $1 million worth of vehicles. Well, the person that guaranteed the loan, they're not owed just 100,000. They're owed 400,000, right? So that's because they took the risk of guaranteeing a loan for the business. It wasn't the business. That person that personally guaranteed that loan, they are on the hook since the personal guarantee. The whoever gave the loan, let's say it's a bank, whatever, they go after that person personally. They can take their house. So that's a big risk that they took, right? And the only reason why you even got the $100,000 loan is because they personally guaranteed it. So no, they're not owed just 100,000. They're owed 400. So it's one of the things earlier in the book was when somebody personally guarantees, um, be very judicious, be really judgmental and very careful because you're asking for a lot and you're going to pay a lot for it. This one, I find this to be one of the things that is really, people think of it as unfair after the fact if they were a personal guarantor. But while it's going, it's like, well, it's nothing. Go ahead and personally guarantee. You're not really doing that much. I think it's one of the things the book really highlights as trying to be fair and should be thought about more. If a company must find its way to make the payments and the credit is not guaranteed by the grant, so this is not a personal guarantee, then they look for cash contributions rather than pass the hat, right? So whoever's gonna, oh, we owe this, let's go around and let's pay it back now. Um, if a company looks for cash contributions by passing the hat, the grants will view the job as a liability and resign. It's like, hey, I'm working here, but now I'm paying to work. Absolutely not. So this could be like, we're going to go bankrupt, right? If passing the hat would cause the grunts to resign, then the leadership must either cover the debt themselves or close the business. Again, there's personal guarantees and all that. Leadership covers the business themselves, and those payments are treated as cash times four. Again, this whole concept of your personal cash, anyone that this cash contribution is, if you give cash to the business now, and it's, something you need, so you need to buy, let's just say you need to buy a vehicle, let's say it's going to be 15,000, and you contribute that to the business, it's, let's say it's 10,000, it's not 10,000 worth 40,000 is how much you're owed, and that's how much equity you have in the business. But a whole bunch of things with their equity, as soon as you do cash contributions, the equity that the business owns, that now the business is worth that much in a way, and you are owed that much, kind of thing. But let's go back, right? If a leadership is unable or unwilling to cover the debt, then a company must close and liquidate, right? So this is important, right? It's saying a bunch. So you owe money that needs to be paid out, and you just say, I'm not going to do it, but we're going to keep going. No, you need to close and liquidate and pay your debts. If the company closes and liquidates, then any surplus cash is distributed first to the cash contributing grunts up to their contributions, right? And if surplus cash is insufficient to repay all the cash contributions, then the payouts are proportionate to the contributors' cash input, right? So a bunch of people could have contributed, and it's going to be paid out, of course, by what if someone gave 50% of the total amount, what they call a grunt fund, or the pool money, someone gave 50%, and everybody is owed total $1 million, but someone gave 50%, and someone gave two others gave 25% each, but you only have 100,000. Well, one person's getting 50,000, the other two are getting 25. There's no million. The cash remains after repaying the cash contributors, then it's distributed to all the grunts according to their equity percentages. It's not clear, are they getting the times four on this liquidation and then the equity? But I think it is. I don't think it is. They're getting, it says up to what they contributed. So that at this liquidation, you're still, everyone else that has equity, they also were not getting paid. So I do believe um, it's going to be, the cash isn't getting the multiple. So we'll see. We go. It's in the book. After founders learn the market is not as attractive as they first thought, then they decide to cease operations. This is another reason why you could go bankrupt or what have you. The founders resign without the cause, then the leadership in this book, of course, we're the software cooperatives, it's kind of run democratically. This book is saying, okay, this is hierarchical. So someone's always in charge of the grunt fund, and the promises and everything come from them. Then the leadership passes on to the next largest shareholder, which this actually solved the problem. Like, who is going to enforce the rules? And it's the largest shareholder based uh, um, after automatically. So the original leadership may not be the largest shareholder, but after whoever leaves, then it will be as a default. Um, so the whole thing with the LLCs and all this stuff, um, if you liquidate, if you go bankrupt, there's the personal guarantors and all that stuff. The creditors, the people that you owe money to, they're gonna go after everyone personally. Period. If you weren't formed as a entity, of course, there's talk to the lawyers and all that. But if you weren't formed as an entity, they're gonna come after you. And but if you were formed as an entity, they're still probably gonna come after you personally. But you, if you did everything right, you should be protected. So there's that going out of business. Of course, this is the legal side, and this as an overview of this, we got, we'll go for 5 more minutes. As an overview of the legal side, they gave an example. He gives a really compelling example of what he would say is, I won't say, yeah, it's kind of like a bad lesson from being burned. You have people go in and then when they make they get burned and then they make their next entity and then they have all of these contracts, but they figured out how to protect themselves. They make the contracts where they benefit them. And then they bring in new people who are not savvy about being burned. And then they figure out, ooh, these contracts benefit the partner that created the contracts. And I should have the lawyer look at it and all that stuff. None of that stuff happens in an early stage. You're not making any money type entity. So you can make it to where it's unfair and deceptively unfair in the contracts. And they have a good example of it. So if someone's an entrepreneur, then they must work with people they trust. If your first instinct is to protect yourself against the fellow grunts, then you have chosen the wrong herd. That's this whole trust, like how much do you have to trust and all of that. If you've chosen the wrong herd, you're not working with the people you can trust. If you're not working with the people you trust, the first rule of business is being violated. You need to only work with people you trust. If you establish a grunt fund, then you create a foundation for trusting relationship. So the grunt fund is supposed to solve the problem of, or it as a baseline for how much trust you need versus blindly trusting people. It's a way when you put the rules in front of everyone, it it's a promise, and now it's very explicit, and people can commit to those rules on what is fair. Instead of putting it in legalese and then um, having the repercussions of the legalese where people don't understand it, and then of course they have to pay for lawyers. They don't pay for lawyers because no one's making any money. All of that stuff, right? So he's saying use the grunt fund, and then it's best to use the grunt fund with the lawyers that are familiar with the grunt fund. So he's saying that's why you have a grunt fund is implies a trusting relationship or it's tied to one. If you engage a grunt friendly lawyer, you can still be burned because no contract covers all the risk. And if you try to avoid all the risk, you'll be disappointed. Now, this is like a prediction here. This could be a controversial statement here. Of course, nothing is legal advice. He says this over and over, but your company is in the very early days, and you should avoid spending money on extensive legal work until you're confident the venture has legs. This is a chicken and egg problem. Everyone says get a lawyer, and of course you get a lawyer to set up the S corporation, and then what do you have? You have static equity, and that's it, or the LLC, whatever. That is this. Okay, we don't have any money. You're going to pay for the lawyer. Okay, well you're going to pay for the minimum, and you're going to get static equity. If you do have money, right? Like how do you have money? You don't have customers yet. All of this other stuff, and it's like, oh, that's cash contribution, all this stuff. So spending the money, it's like, should you do it or not, right? If you're in very early stage, and your primary focus should be on a proof of concept, not legal formalities. And then if you proceed without legal protection, then your risk is higher, but you may not fall and everything may turn out okay. This is I would say, controversial statements, but it's kind of part of the premise of the book. What the book is trying to say, there's a place for them. Bring them in. They should be familiar with this fairness concepts. If you discover paying demand for your product, then it's time to set up basic legal structures. Of course, we talked about these legal structures are going to be like S corp, LLC, and all this stuff. So this is like, how do you engage the lawyers? If you set up legal structures, then you should discuss liability, ownership rights, and taxation with the lawyer. And uh, you know, from my experience, taxation with a lawyer is going to be silly. I'm going to go ahead and put, and then you're going to have better outcomes with that. If you create a formal business entity, then it helps protect the owner's personal assets from corporate liabilities. We just talked about that. This is what the lawyer is going to be telling you and what you need to talk to them about. You need to separate the personal and corporate. This is all normal business stuff. And this is a kind of interesting thing. If you contribute to the company, then whoever contribute the thing to the company, they don't own it anymore. The company owns it more. Often, owns it. Oftentimes people think, hey, I contributed this piece of equipment or what have you, and I didn't get paid for it, whatever. Well, that now is covered by the slicing of the pie. You don't own it anymore. And you should be compensated based off of the pie with the risk adjustments and all that go with it. But you don't, when you leave, you don't get to take it, right? And this part here is important. And again, you have to talk to the CPA and all that stuff. Um, you need maximum flexibility. This is talk to the lawyer. He has a bunch that he says are familiar with the system, but he's gonna say the LLC is better because it allows you to do distributions and stuff like that versus the static. It's going to be better, but of course, talk to the lawyer. Um, if you're expecting investments, then a corporation is going to be better, and I'm assuming it's means C corp. Okay, yeah. Um, or LC taxes S corp. Let's see. If stock is granted to grunts only after the pie is baked, then IRS may treat that stock as a taxable compensation. So look at that. This is a part that is one of the more important parts about this book. That's why it's a theoretical value. So you're not giving stock. And I think when I'm going through this, there's another entity um, called it's basically a trust owned company where you may be able to put these rules into it and avoid that same problem. Instead of having one person, someone has to own the stock. Instead of having one person own the stock, and that's a promise, you can probably do this trust based entity um, where the trust owns all the stock in the LLC or whatever. If you want to avoid IRS compensation and tax on equity, you must grant restricted stock early and file this election. So these are things why why the grunt fund avoids saying, it always talks about theoretical value. And of course, he talks about, hey, if your lawyer says I don't know about any of this, then he's saying go find a lawyer. It was like with cooperatives and stuff like that in the United States. Most of them don't know anything about cooperatives, all that. And we say find you another lawyer and talk to them about cooperatives or and the CPA as well. Then there's plenty out there that know about it. But there's that. And then just some final comments. If a startup's to succeed, it's got to create a high level of trust. If you have to create a high level of trust, the leaders must earn trust and maintain it. The leaders earn and maintain trust, then they must share fair rules with everyone and secure agreement to follow them. The fair rules are shared and agreed in advance, then they can uh, create a grunt fund or a good foundation for one. If it has a sound the grunt fund has a solid foundation, then the startup can move forward together without excessive hassle. And if team members disagree with the default rules, then they can create their own rules, right? So you can modify this. And he gave some good ideas about where to start. These are good starting points. And he's basically has predictions in there. It's like, yeah, if you mess with this or you tweak this, this is what you have to worry about. The rules are changed in the middle of the game without the input, then that's gonna poison everyone, and they're gonna think that it's not fair. And if they have no rules or not settled on the rules in advance, then it's gonna face real danger with the run fund. And that looks like that's it. Let's do one more here. Uh, well, let's do this. One more little rules, a final one. If a rule absolutely must be changed, then every grunt's input must be obtained before adopting the change. And that's really it. So, any questions, comments?